Hey, how are you? I'm Duncan McPherson and welcome back to my channel. I have a thought-provoking video for you today, and it's the first in a four-part series where I will be providing you a checklist of things to consider as you expand your business into Canada. The first video will deal with things for you to consider as you structure your expansion into my great country. And our next video will deal with CRA's anti-avoidance rules that you must continually keep in mind as you do your Canadian tax planning and Canadian tax preparation. And as always, before we get rolling, don't forget to hit that subscribe button and notification bell if you want more tips on how to survive and thrive in the Canadian tax world. Or if you'd rather cut through the nonsense and get expert help right now, contact me through the MacTax.com and let's get chatting. So in today's video, I'm going to provide you with some food for thought as you expand into Canada. You will be familiar with a lot of this stuff, but here it is as a checklist for you as you move forward. So the first thing you'll need to consider is, will you be expanding into Canada as a branch of your US company or as an incorporated Canadian subsidiary? A big part of the decision here will be tied to the amount of Canadian profits that you anticipate making in the short and medium term as you move into Canada. And let's define the medium term here as 3 years. Okay, so for example, if your profits will be small in this initial period of time, it is likely that you'll want to use a branch and take advantage of the treaty provisions that protect your branch profits from withholding taxes. And down the road, once your profits are growing, you may wish to roll your Canadian branch into a Canadian corporation. Keep in mind, though, that you could be taxed on this transaction in the United States. It is likely that tax can be avoided by invoking Internal Revenue Code Section 351. Another thing you may wish to consider here, it is administratively easier to file your Canadian tax return as a domestic corporation than as a branch of a US corporation. And why is this, you ask? Well, the reason is, although most corporations will maintain a separate set of books and records for an incorporated subsidiary, believe it or not, nobody wants to maintain a separate set of books for a branch. It seems every time I have to do a branch return for a foreign corporation up here in Canada, the income statement and balance sheet never exist, and you end up scrambling to get them done. And what have I told you in about a dozen other videos? You know, the shit that happens when you scramble to put together financial information? Exactly. The CRA algorithm notices your sloppy bookkeeping and then sends you a very pleasantly worded review letter. Okay. So now let's say you've decided on an incorporated subsidiary. The next thing you have to consider is, how will you capitalize your Canadian operations? Keep in mind that the thin cap limit here in Canada is $1.5 of debt for every $1 of equity. And any interest you pay on outstanding debt above this ratio will be denied as an expense. But don't worry, because I'll tell you more about that in my next video. At this stage, just keep in mind that all expenses in Canada are subject to reasonableness under Section 67 of the Income Tax Act. Therefore, if you charge an unreasonable rate of interest to your Canadian subsidiary, you will be denied a deduction on the portion of the interest that is considered unreasonable. And your denied interest can and will be recharacterized as a dividend to your parent company. And again, this dividend would be subject to withholding tax. But you should keep in mind that you want to put as much debt as you possibly can into your Canadian subsidiary, because you do not need to pay withholding tax on the interest you pay to the US parent. And this is a vice versa rule in the United States too. But remember, there is a 5% withholding tax on dividends. Okay, so now next on my list is how you repatriate profits. Right now, your Canadian tax rate up here on your Canadian corporation is 26%. If your parent corporation resides in a state where the combined tax rate is less than 26%, it is advantageous for you to move as much of your profits as possible out of Canada and into your US parent. Please don't tell the CRA I told you so. This can be done by charging your Canadian corporation interest, management fees, royalties, sharing costs, etc. But I caution you, as soon as you expand into Canada is the time for you to make the decisions on how you're going to repatriate your profits. If you've been in business for 5 years and then all of a sudden you decide to start charging a royalty or a management fee, CRA is going to take a very hard look at these charges and likely to reassess. But even if they do not reassess, they will notice it, they will ask you questions and make you provide bagloads of information as to why you've made these charges, and it's a lot of hassle. So please do it from the get-go, not years into it. But more on this in the next video. Just note that all your intercompany charges will always be subject to CRA's reasonability criteria, again, under our Income Tax Act, Section 67. If amounts paid back to your US parent do not meet CRA's reasonableness criteria, the payments will be recharacterized, and they'll be recharacterized as dividends, and again, withholding tax will apply. But again, more on this in the next video. Something else to consider on my list, will you be bringing in Canadian partners in the future? This is a very interesting topic, and let me tell you why. If your Canadian partners become 50-50 with you, then your tax rate drops from 26% down to about 12.5%. So if you see yourself taking on Canadian partners in the future, make sure you have a pliable enough capital structure in order to do so. Okay, next on your checklist, research and development. Oddly enough, up here in Canada, this is actually widely known in the US, I'm always surprised to learn that. Up here in Canada, our research and development tax credits are much more generous than they are in the United States. So if your company is undertaking research and development activities, you may wish to shift some of those activities up to Canada to get the benefit of our research and development tax credits. And something else for you to consider, and next on my list, when it comes time to sell, how will you exit Canada? If it is necessary to own real estate to operate your business here in Canada, you may wish to hold the real estate in a separate corporation, not owned by the Canadian corporation, owned directly by you or your US company. Because if you choose to sell out in the future, the sale of your Canadian corporation will not be taxable in Canada, as long as the value of your shares is not substantially derived by the underlying real estate. However, when you sell the corporation that owns the real estate, you will be required to pay capital gains tax here in Canada, but you'll get a credit in the States. This is very similar to your FIRPTA rules. Well, I haven't even really begun the list here because I have a lot more to say about expanding into Canada, but this video is getting too long. And think about it, on top of all of the issues discussed here so far. So let's just end with my final box on the checklist for today. Your own personal affairs, meaning your own succession planning, your own estate planning, your expansion planning, and tariffs. And the list goes on. So what you got to do if you're coming into Canada is give me a call and let's knock heads and come up with a great plan of attack for you. Because unlike my previous videos, all the stuff I'm asking you to do here actually is CFO level stuff. For once, this is just not about the bookkeeping, like I've been telling you over and over again in all my previous videos. Everything I've just told you is very serious tax planning. But please, once your tax planning is done, for God's sakes, keep your books and records up to date, or all of your tax planning will go to hell. And unlike my previous videos, this is the time and place for the big boys. And like I said, there's more I want to discuss with you in the next video. So for now, I'll leave you with this final thought. It is important for you to look at all of this stuff at the outset and get your policies, procedures, and bookkeeping in place. Because if you wait to do this 3 years out, I'm going to be making a lot of money and CRA is going to be asking you, why are you changing things? And start recharacterizing your expenses. And CRA can cut through this shit like a hot knife through butter. Go ahead, just try charging large management fees 5 years after the company has already been operating and see what happens. And fine, in all my previous videos, I've harped on how you should be spending time and efforts on your bookkeeping, not on the bean counters and the shysters. And guess what, my friend? This is the time for you to call in the good bean counters and the good shysters. But on the other hand, if you do not wish to take my advice, you will likely be paying a lot more taxes down the road. And then you'll wish you had listened to everything I told you just now. But all right, that's it for today. So just to reiterate, here is the starting checklist of things to consider when your business is about to enter Canada. Number 1, will you use a branch or a sub? Number 2, how will you capitalize your operations? Number 3, how will you repatriate your profits? Number 4, will you be bringing partners in the future? Number 5, are you performing research and development? Number 6, how will you exit Canada? And number 7, of course, your own personal affairs. And I know you already know all this, at least from me. But so many of your tax problems can be avoided with some serious tax planning at the outset. And let's be honest, if you watch this far, I've triggered something for you, correct? So if this sounds like you, don't forget you can always call me at the MacTax.com and I'll make sure that you don't have to worry about this shit. Of course, as always, don't forget to subscribe for more tax savings tips. Until next time, stay sharp, stay compliant, and stay out of tax trouble. I'll see you on the next video.